What if I told you? Your money isn't really just sitting in the bank. Right now, just 10 banks control over $25 trillion. That's more money than most countries will ever see. But here's the crazy part. The entire banking system started on wooden benches in medieval Italy. The same system that helps you buy a house can also collapse economies, wipe out jobs, and crash the world. So how did banking go from solving a currency mess to nearly destroying the global economy? In this video, we'll uncover how banks really work, why they failed, and who might control money next. Stay with me. The international banking system can feel like a mystery. There are over 30,000 banks around the world, managing mind-blowing amounts of money. In fact, the top 10 banks alone control about $25 trillion US. While banking today may seem complicated, it actually began with a very simple goal: to make everyday life easier. Back in the 11th century, Italy was the heart of European trade. Merchants from across the continent gathered there to exchange goods, but they faced a big challenge: too many different currencies. In the city of Pisa alone, traders had to deal with 7 types of coins, constantly swapping one for another. These exchanges often happened on outdoor benches, called banco in Italian, which is where the word bank comes from. Travel was dangerous, fake money was common, and getting loans was difficult, so people began searching for better solutions. This led to new ideas. Local brokers started offering credit to business owners, while merchants in Geneva pioneered cashless payments. Soon, banking networks spread across Europe, lending money not only to traders but also to churches and kings. So how do banks work today? Simply put, banks manage risk. People deposit their money and earn a small amount of interest. Banks then lend that money to others at higher interest rates. This involves risk because not everyone will be able to repay their loans, but it's a risk banks carefully calculate. This system is vital for the economy. It helps people buy homes and allows businesses to grow and expand. Banks take money that would otherwise sit unused and put it to work for society. They also earn income through savings accounts, credit cards, currency trading, custodial services, and cash management. However, a major issue today is that many banks have moved away from their traditional role of offering long-term financial stability. Instead, they chase short-term profits that come with much higher risks. During economic booms, many large banks created complex financial products and traded for their own gain, aiming for quick profits and huge bonuses for executives and traders. This behavior was closer to gambling than responsible banking, and it caused serious harm to economies and societies. A clear example is the 2008 financial crisis, when banks like Lehman Brothers handed out home loans to almost anyone. This risky behavior led to the collapse of the housing market in the US and parts of Europe, triggering a global banking crisis and one of the worst financial crashes in history. Trillions of dollars vanished, millions of people lost their jobs, and trust in bankers dropped sharply. Governments in the US and Europe stepped in with massive bailout packages to stop banks from collapsing completely. Many banks were fined billions of dollars, and banking became one of the least trusted professions. In response, new regulations were introduced. Banks were required to keep emergency funds to protect against future crises. However, some stricter laws were blocked by strong banking lobby groups. At the same time, alternative ways of financing started to grow rapidly. One example is a new type of investment bank that charges a yearly fee instead of earning commissions, encouraging them to act in their clients' best interests. Another option is credit unions' member-owned cooperatives that began in the 19th century to protect people from loan sharks. They offer similar services to banks but focus more on shared benefits than maximizing profit. Credit unions aim to help members start small businesses, grow farms, or build homes while reinvesting in local communities. Members control these institutions and democratically elect their leaders. Around the world, credit unions range from small groups to large organizations managing billions of dollars. Because they prioritize their members, credit unions tend to take fewer risks. This is one reason they performed much better than traditional banks during the last financial crisis. Another growing trend is crowdfunding. Beyond funding creative projects like video games, crowdfunding platforms allow people to lend money directly to others, cutting banks out as middlemen. Many tech startups began through platforms like Kickstarter or Indiegogo. Investors enjoy supporting ideas they believe in, while spreading the risk among many people so that individual losses remain small if a project fails. Finally, there's microcredit, very small loans, mostly in developing countries, that help people escape poverty. These loans give individuals access to capital they were once denied, enabling them to start small businesses. Today, microcredit has grown into a multi-billion-dollar industry. So, even if banking isn't your favorite topic, its role in providing funds to people and businesses is essential to society. Banking will always be necessary. The real question is who will provide these services and how they will do so in the future.